Hello, and welcome to the GHP Investment Advisors Annual Economic Forum. Thank you all for joining us today. I am Christian Lewton, Chief Investment Analyst here at GHP. Joining me on stage today is Brian Friedman, our President and Chief Investment Officer. Also, Carin Wagner, Senior Vice President of Wealth Management, and Mike Sullivan, Vice President of Wealth Management. So before we get started today, we did just want to go over a few housekeeping items. So first, we wanted to mention that today's lunch is more of a family style. So please help yourself to, I believe it's the salmon in the middle of the table and the other toppings. Also here, if you are looking for the coffee, it should be located on everyone's table this year. So no need to go run and find it. Restrooms, so if you do need to use the restrooms are located just outside of this main room on the backside of the stairwell out there. And finally, if you would like to stay after the presentation today to enjoy the art museum, please just remember to wear the sticker that you received at check-in. All right, so before we jump into today's discussion, we did also just want to take a moment to highlight our growing team here at GHP. So we now have 27 dedicated team members, all of whom are crucial in allowing us to deliver the exceptional service to all of you. And we're going to quickly go through by department here. So starting with our team of 6 advisors. Hopefully it should help you put a face to the name as well. 3 will be actually leading our presentation today. Next, we have the 4 members of our financial concierge team. So this is going to be your go-to group for more personalized attention or complex problems. Here we have the 5 members of the research, trading, and portfolio analytics group. A mighty handsome crew of 5 members, I might add. Next, we have our 6 client relations members. I'm sure many of you have had the pleasure of interacting with them over the years. And last but not least, we have our 6 more behind-the-scenes team members, which includes our business intelligence group, marketing, and corporate staff. All right, so now moving to today's discussion. So being that it's an election year, we could have opted, and honestly probably should have opted, to avoid any controversial topics, especially given that we do not want to see any wrestling matches here today. However, as many of you probably know us by now, that's not really our style. So instead, we decided to run straight through the political battlefield and discuss the budget deficit as well as the escalating U.S. Federal government debt. If you've been a client, maybe you've even just followed us on social media for the last few years, you're already likely very familiar with our thoughts on the growing budget deficit as well as the escalating debt. We've consistently highlighted these issues in our quarterly newsletters over the years, and I'm sure many of you have heard them mentioned in your semi-annual portfolio reviews as well. And we even actually created a video just a few years ago, I believe it was in 2021, which we're actually going to share with you right now, as it should help set up today's discussion.
Excessive debt is a risk that we are always watching out for at GHPIA. It's a factor we analyze when determining the growth potential of individual stocks, using several metrics to gauge the threat debt poses to an investment's future value. But debt is also a risk we monitor in the economy at large. As we noted in our video about the 2008 financial crisis, excessive leverage throughout the real estate market offered early warnings about the collapse. When the COVID pandemic hit in 2020, there were fears that private debt would again cause a financial crisis, especially with many businesses shuttered and rising unemployment. But many of the cornerstones of the economy and the financial system entered the pandemic in much healthier shape in terms of debt than they were in 2008. households were carrying much less debt as a percentage of their disposable income. Corporations also held much less debt relative to their equity market value. And banks had sufficiently built up their capital cushions in preparation for liquidity emergencies. Even state and local government debt had stabilized and begun to shrink. The one area that remained worrisome was federal government debt. Even before the pandemic, public debt as a percentage of gross domestic product had begun to approach levels not seen since World War II. To help bridge the economy through the devastation of the pandemic, the US government added about $5 trillion to already high levels of public debt. In fact, there's even a formerly unorthodox economic philosophy called modern monetary theory that is becoming more mainstream. MMT dangerously argues that radically increasing the national debt isn't problematic as long as inflation and interest rates remain subdued. Nonetheless, interest rates likely won't stay near all-time lows forever, and taxpayers will have to pay back the extra trillions spent in 2020 eventually. As wealth managers, that's where we see potential risk over the next decade and beyond. Debt-minded investors are watching for tax increases and government spending cuts, both of which could slow the economy. There is also risk of inflation. Even more dangerous scenarios involve defaulting on debt and weakening our currency as a result. Does this mean a collapse is imminent? Not necessarily. As the wealthiest country in the world, with the dollar still maintaining its prominence as the world currency reserve, the US has advantages beyond all other countries in shouldering higher debt. Further, as interest rates have remained low for over a decade, the interest expense burden from the national debt is manageable relative to prior periods, such as the late 1980s. The much healthier levels of private debt held by households, corporations, and banks helped the economy remain resilient as it navigated the pandemic. We will maintain a close watch on the national debt so that we can keep client portfolios resilient as well.
And with that, I'm going to pass it to Brian to kick us off.
Thank you, Christian. Can you hear me okay? The most important change since that video was released in 2021 is that interest rates are no longer low. Of course, everything else in that video still holds. The national debt, if we look at the period before World War II through the end of the war until now, we'll just take a little bit of a tour and set up our more detailed conversation of the debt, the deficit, and where we have come and where we're likely to go. The first thing I want to clarify is the national debt. Is it almost 100% of gross domestic product? Is it 130% of gross domestic product? There's a variety of measures that you might have come across, and it really depends on how the author of the article or the news story wants to, what sort of emotions they want to prey upon. For those of us who want to, or for those sources that want to make you extremely nervous, they tend to focus on not just the debt that the public owns in the form of treasury bonds, but also somewhat fictitious measures of debt like the Social Security Trust Fund. Meaning, there is debt, which we're going to focus on today, which are actual treasury bonds, actual loans of cash from the public, meaning us, meaning you, many of you in your portfolios own these treasury bonds. That's why we're talking about it today. But also, on top of the treasury bonds that the government issues, there's a variety of accounting measures. The most commonly cited is the Social Security trust fund. Suffice it to say for our conversation today, that is merely your left pocket making a loan to your right pocket. If I wanted to make everybody extremely nervous, I would include that in my debt measure. If I wanted to make you paranoid, I would also include unfunded liabilities for Medicare, Medicaid, and Social Security. Today, we are just going to focus on the hard cash that the government owes, the hard cash the government spends, and the hard cash that the government continues to borrow. On that basis, the public debt is now approaching 100% of gross domestic product, the total value of goods and services produced in the United States. The only other time in modern American history that our debt was at that level was World War II. If we look at the trajectory of the debt since World War II, you will immediately notice that as we came out of that war, the economy grew, the government maintained a certain degree of fiscal responsibility in the 1950s into the 1960s, and in fact, the government debt as a percentage of gross domestic product fell from the end of World War II until the mid-1970s. What changed in the 1970s? Well, in the middle of the 1970s, because of a stagnant economy, rising inflation, interest rates began to skyrocket, eventually hitting double digits, almost 20% in the early 1980s, and remained elevated all the way into the 1990s. So you will notice that starting in the mid-1970s, the debt as a percentage of GDP rose, and it rose all the way until the early 1990s. The first presidential election that I ever voted in was 1988, George H.W. Bush versus Michael Dukakis. I don't know if anybody remembers Michael Dukakis, but I was watching the speech, like many of you, at the Republican National Convention that summer, where George Bush uttered his famous phrase, "Read my lips, no new taxes." Well, how do you know when a politician lies? His lips are moving. So as a result, George H.W. Bush, only a couple of short years later, raised taxes. Why? Because the debt and the deficit was on an unsustainable trajectory, and something had to be done. And spending also came under control. And you will notice, starting in the mid-90s, it really took hold, and the debt as a percentage of our economy fell until another George Bush came along. And in his administration, there was a tax cut, and then September 11th, 2001, and we fought wars in Afghanistan and Iraq, and as a result, the debt began to rise once again. And as you will see, the debt from the wars and the tax cut increased, but it was nothing compared to what happened in the global financial crisis, and that was nothing compared to what happened in the pandemic. And that has brought us to the situation that we're in today. And if we look at the forecasts from the Congressional Budget Office regarding where our debt is going in the next several years, we are on our way to not only surpass our World War II high, but we will absolutely blow it away. And it's going to occur not in 10 years, not in 20 years, not in 30 years. It is going to happen in the next few years. And just so you know that the assumptions that are baked into the Congressional Budget Office forecast are very conservative. In a minute, I'm going to talk to you why, but we are likely to exceed these forecasts rather than undershoot as we have in prior years. Okay, one more point of clarification. Hold on, I got to open up my timer. There we go. The way that economists like to think about the deficit is they talk about the primary deficit, and that is everything that we, all the spending that exceeds taxes except interest expense on the debt. So if we look at the total deficit, there's net interest, there's the interest that we spend on our debt, and then there's the primary deficit, which is everything else. If I go back to the years starting in the 1970s through the financial crisis, those years where the deficit really got out of control, where interest rates were hitting 20%, you'll notice the net interest, the red in this chart, was in fact much larger than the primary deficit, and it forced the hand of the government to change its policy, and starting with George Bush's utterance of no new taxes and therefore a tax increase, we shifted to a surplus and interest rates came down. And as a result, for most of the last half of the 1990s, we ran a surplus, followed by tax cut, war, and therefore a deficit, albeit a modest deficit. And then the financial crisis and the pandemic occurred. These are the biggest deficits that the government has ever run, even compared to World War II. This is the forecast for the Congressional Budget Office. The forecast, you will notice, is assuming that the primary deficit shrinks, but that the interest expense continues to grow. And I'm here to tell you that the interest rate that they assume is less than 4% in these coming years. The odds are very high that interest rates will be higher than that, and therefore the deficit larger. Let's drill down on interest. 10 years ago, the federal government spent $230 billion in interest expense. In 2021, the government spent about $300 billion in interest expense. So, in about that first 9 years before the Federal Reserve raised interest rates, interest expense didn't really go up all that much. But then you'll notice in 2023, interest expense was $658 billion, meaning almost triple what it had been in 2014 and double what it had been only 24 months earlier in 2021. This is what it's supposed to be this year, $870 billion. In other words, almost quadruple what it had been 10 years earlier. And then this is what the Congressional Budget Office projects over the coming decade. And I want you to know something very important. It's highly likely to be larger than this because the interest rate assumption is too low, the government's interest rate assumption. $870 billion in interest this year is equal to what we spend on defense. 10 years ago in 2014, interest on the debt was 60% of the defense budget. 10 years from now, interest expense will be 60% larger than the defense budget. Now that I have fully alarmed everybody in the room, we're going to bring it back down, and Carin and Mike are going to talk about how this problem will be dealt with. We believe this is not a civilizational event. This is not something that is going to collapse American civilization. This is not something that is going to collapse the dollar. This is something that is not going to end America as we know it. But what it will do is what it has done in the past. This situation will be addressed. We're going to talk about how and why, but it will not be addressed because of political foresight. It will be addressed because the bond market will force Congress and the president to address the problem, as has happened every single time. Under Reagan, under Bush, under Clinton, under George W., the bond market was the dictator of this situation, not the politicians. One last note, and I'll turn it over to Carin. We have this little section that we call mandatory spending, which includes interest expense, Medicare, Medicaid, Social Security. We call that mandatory, or I should say the government calls it mandatory, because under current law, no further authorization is required. It just happens because of demographics, because of how the benefits are built. However, there is actually only one category of mandatory spending: interest on the debt. That is contractually, it's a contractual obligation. If the government does not pay the interest on the debt, it's called default. If America were to default, all those bad things that I just mentioned would happen, which is why America will not default. Every other category, Social Security, Medicare, Medicaid, is actually not mandatory. I now turn it over to Carin to talk about why.
Well, Brian just explained that we have a debt problem. I'm going to talk today, right now, about how noble intentions of the past have led to staggering financial obligations. We'll just call it the high cost of good intentions. Allow me to illustrate. This chart is a visual representation of our government spending. If you look at the yellow outlined with the dotted line, that's what Brian was calling the mandatory, not mandatory spending. So Social Security, Medicare, and Medicaid. In 1962, on those three programs, the United States spent 13% of their total spend. Fast forward to 2024, and that amount is now 47%. And fast forward a decade from now, and that amount is projected by the Congressional Budget Office to be 52% of our total spend. That's over half. Keep in mind, if you look at the very bottom of the chart, there's a gray section. That's the net interest. So we have the rising net interest cost plus higher, what they call entitlement programs. Another way to illustrate the magnitude of this problem is to look at the federal government spending per capita. In 1959, each American, the federal government spent $5,341 per American. Fast forward to 2023, a 70% increase at $19,046. And by the way, these numbers are inflation adjusted. Before talking about the future of US government spending, we think it's important to reflect on the two pillars of our social safety net. That's Social Security and Medicare, since both of these programs have undergone significant changes since their inception. The Social Security Act of 1935 was born out of the visionary ideals of the New Deal. Consider when Social Security was introduced, the life expectancy was just under age 62, with benefits beginning at age 65. Now life expectancy is 79 years old for the average American, which means that when this program was established, it was not established to provide 14 years of benefits. Even when it was enacted, it wasn't sustainable. So I'd like to introduce you to Ida Mae Fuller. She's from Vermont. She was the first beneficiary of recurring Social Security payments. She paid in between 1937 and 1939 only $24.45. Her first check was $22.54. And get this, she lived to be 100. So she's the perfect example of why Social Security isn't sustainable. She received $22,888.92 during her lifetime. That's a lot. When Medicare was first introduced in 1965, the landscape of healthcare looked vastly different than it does today. The average US life expectancy at the time was 70, so the vision was providing healthcare benefits for about 5 years. Fast forward to today, and thanks to remarkable medical care advancements, many in this room are recipients of that, we're all living longer at a time when the cost of healthcare costs are skyrocketing. Older Americans now pay only 13% of their out-of-pocket expenses, compared with a staggering 56% in 1966. So let me, what's that? So let me say that again. Older Americans in 1966 paid 56% of their out-of-pocket healthcare expenses. Today it's only 13%. Did that clarify? Okay.
You're good both ways.
What's that?
You're good both ways.
Okay, I got it. Just checking. You never know. And right now, more than 65 Americans have Medicare benefits. You may recognize this cartoon because Mike and I presented about the future of Social Security a decade ago in 2014, warning about the tsunami. Well, guess what? The tsunami hit, and the final wave is going to come through in just 4 years when all baby boomers turn age 65. So within that decade, not only did we have the tsunami that hit, so higher entitlement program costs, we also had pandemic spending, which Mike and I did not predict, and we have higher interest rates. Since 2019, overall federal government spending on an inflation-adjusted basis is up 20%, and over 45% if you don't account for inflation. Social Security and Medicare Part B hospitalization insurance is a pay-as-you-go system. So what that means is that current workers are currently paying for current retiree benefits. And the problem is that the worker per retiree is going down, especially as we have baby boomers starting to take all of their benefits. So in order to bridge the shortfall and to continue benefits of both Social Security and Medicare Part A, they each have their respective trust funds. The problem is that the Medicare Hospital Insurance Trust Fund is projected to be insolvent by 2031, and the Social Security Old Age Survivors and Disability Insurance by 1935. Without any reforms, Social Security benefits will be reduced by 20%, and Medicare Part A insurance will be cut by 11%. Even with these high costs, we believe Americans will safeguard these benefits for those that need it. Currently, Social Security represents 30% of income for those over the age of 65, and more than 40% of Americans depend on Social Security for more than 50% of their income. So it's not going away. Now what we're going to do is Mike and I are going to introduce to you the Wagner-Sullivan deficit reduction proposal. Yeah. Keep in mind that we're wealth managers and that we're not running for office. And after you see our proposal, we might not earn your vote. We know from years of working with clients, especially as it relates with their budget, that it's much harder to cut costs than it is to increase revenue or work longer. So as we were trying to put this proposal together, our goal was really to take 50% from spending and 50% from revenue increases. You'll see that we weren't able to get it balanced. The Congressional Budget Office outlines 59 proposed, and they quantify it by the way, proposed deficit reductions over a 10-year period. Of these options, there are many that aren't even quantified, like having participants pay for Medicare Part A or participate by paying premiums, deductibles, or copays. So our proposal only includes the proposals that are quantified by the Congressional Budget Office. All right, here we go. These are our 4 spending cut proposals. The first one is to establish caps on federal spending for Medicaid. So right now, Medicaid is a joint federal-state program designed to provide health care coverage for low-income individuals and families. Currently, almost all funding for Medicaid is open-ended, meaning that if states spend more because of more enrollees or higher costs, then the government has to foot that bill automatically. The federal government now pays 59% of the Medicaid costs, with the state providing the remaining 39%. In 2023 alone, the federal government spent a staggering $528 billion on Medicaid, with states paying an additional $358 billion, which was an increase of 8.5% from just 2022. By establishing overall caps that set a maximum amount of funding the federal government would provide to each state, Medicaid would save $126 billion in the year 2030. The next proposal is to make changes to Medicare Part B, which is the outpatient, and Part D, which is the prescription drug plan, basically having participants pay 35% of the costs. Currently, with Medicare Part B, premiums account for about 25% of the total costs, and the premiums for Part D account for 25.5%. So by having participants pay 35%, that would save the US government $61 billion in the year 2030. The concept of changing premiums for Medicare Part B or Part D is not unprecedented. In 2007, a significant change, which has impacted a lot of you in the room, was made with high income surcharge for Part B beneficiaries for enrollees with high income. That threshold was just increased in 2019 to include a bracket for those that have AGI above 500,000. Similarly, in 2011, the income-related monthly adjustment was introduced to Medicare Part D. That's the prescription benefit plan for those with high income. So that's the second proposal. The third proposal is to raise the full retirement age for Social Security. In 1983, which was the most recent time that there was fear of Social Security insolvency, that was under Reagan, the full retirement age for Social Security was raised to age 67 over a 4-decade period. This is a similar proposal, gradually raising the retirement age from 60 to 70 by 2 months per year. So that means that retirement age for those born in 1978, full retirement age would be age 70. By the way, that's the year Mike was born. So, also as a side note, until 1984, all Social Security benefits were tax-free. Now they're not all tax-free. And then finally, the fourth proposal to cut spending is to raise the eligibility for Medicare from age 65 to age 67, and then eventually to age 70, really to account for a longer life expectancy and higher healthcare costs. By doing that in the year 2030, we would save $7 billion. So I've discussed changes to spending, especially for well-intentioned programs that are creating a heavy toll on our economic well-being. Like Brian said, like we've said before, we've been here before. The high cost of good intentions may seem daunting, but small changes over time will take us one step closer to fiscal responsibility. Now it's Mike's turn, and he's going to start with positive news.
Thanks, Carin. Just a quick couple of comments. I wanted to thank the Denver Art Museum staff. You guys have been great. This is our third year here, and we love this beautiful building, and you guys do a great job. Also wanted to point out, we are meeting today where the markets just hit all-time highs again, which is nice because I know we've been talking about some bad news, and I'm going to get into more of that with tax increases. But inflation numbers this morning for the month came in a little lower. It looks like inflation readings for the moment have recaptured the trend of trending lower slowly, so the market liked that, and bond rates have ticked down and stocks up. So it's a good day to be meeting on a beautiful spring day to talk about spending cuts and tax increases. And it's always a pleasure to have you guys and gals turn out for this event, and a privilege to manage your wealth. The good news is that over the 15 years subsequent to the financial crisis, U.S. household net worth has enjoyed an astonishing increase of
$97 trillion through the end of the year, and if we were to include market gains year to date, over $100 trillion of gains at the U.S. household level in 15 years. The debt is likewise astonishing, and the fact that we were at $5 trillion of public government debt in 2008, and we're at $27 trillion today, so there's a $22 trillion increase, but households have enjoyed significant wealth accumulation over this same time period. Equally impressive, U.S. economic growth using the time period just before the pandemic struck through end of year last year. U.S. GDP has risen from 22 trillion to 28 trillion. That's a $6 trillion increase in 5 years, over 25%. When we adjust for inflation, 8.25%. U.S. exceptionalism is still alive and well, especially when you compare our growth to other advanced economies throughout the world. No advanced economy comes close to the U.S. in terms of economic growth over the last 5 years. And I would venture to say it's the same for household net worth trends likewise. So with that as sort of the foundational good news from which to work off of, let's talk about the less appetizing portion of this presentation, which is tax increases. If we use the Biden tax proposal laid out in the State of the Union for 2025 as just an example, some food for thought, if you will, what I want to emphasize to Brian's point, that unlike under the time of President Reagan or President Bush, President Biden's feet have yet to be held to the fire with the bond market. The bond markets are not convulsing. Interest rates have risen, but they are still slightly below historical averages if we're looking at like the 10-year Treasury bond rate, which today is around 4.3%. So the proposal for tax reform from the president, which includes $4 trillion of increased tax revenue over the next decade, also comes with a fair amount of additional spending. And when we use some of the analysis put forth by nonpartisan groups like the Tax Foundation or the Committee for Responsible Federal Budget, they have looked at the Biden proposal, which the White House rolled out as a $3 trillion deficit reduction over the next decade. And those nonpartisan groups have instead, under their calculations, when accounting for the additional spending under the Biden proposal, have argued that the deficit reduction would only be in the neighborhood of $1 trillion, give or take, over the next decade. And what's relevant about that, and Brian mentioned it, the elephant in the room is that the interest expense on the $27 trillion in government debt annually will exceed $1 trillion here within a couple of years. So this is the first step, what we feel is the beginning shot fired to recognize that all politicians over the coming years will start talking about deficit reduction packages, but it's not draconian in the sense of spending cuts, like Carin was talking about, to go along with tax increases. We believe as financial planners that you must have a recipe that includes both, tax increases and spending cuts, in order to tackle the debt burden over the long term. And just quickly, on the tax proposals from the Biden campaign, we watch these things very closely, obviously. The president doesn't set the tax policy, as we know. Congress does this, but they can influence where taxes are going. If we see this proposal come to fruition, corporate tax rates would go from presently 21% up to 28%. That's pretty much the biggest leg of the tax increases over the next decade. Pre-Trump tax cuts, corporate tax rates were at 35%. So Biden is looking to strike the middle there by raising to 21%. Also, there were significant income tax increases on those individuals making more than $400,000 a year, or households making over $450,000 a year. And there are a variety of tax proposals that would keep us on our toes as your wealth managers and portfolio management team. But let's just say, these are proposals. They serve as an example of where the policy may go. We as a firm believe there needs to be some combination of spending cuts to go along with the tax increases. Going forward, when we think about where tax increases may come from or where they may be focused, we have to look back. And so historically, we find that over 100 years ago, government revenues were primarily derived from excise taxes. And these were taxes on things like alcohol and tobacco. The irony is not lost on me that 100 years ago, people were smoking more. They were not living as long. 100 years ago, it predates both Medicare and Social Security. So now these programs are under the burden of a good problem, which is that we're living longer and healthier lives. But now, of course, we have the deficit to go along with those programs. The individual income taxes and payroll taxes are the primary source of revenue today. The $4.5 trillion of government revenue in 2023 was derived, 85% of that was derived from income and payroll taxes. We believe that any tax reform in the decade ahead will focus on those two pillars of U.S. tax revenue. We talk all the time as a firm about estate tax planning with our clients. Note that it only is a sliver of the pie. It's less than 2% of federal tax revenue that comes from estate taxes. Also, looking back, we can see a precedent, and my partners have spoken about it, namely with the presidencies of Reagan and Bush. The period of the 1980s, if we were just to isolate those tax bills, this chart is showing how tax increases impacted the GDP going forward in the 2 years subsequent to each tax increase bill. And I want you just to take away that you see there are numerous tax increases over the last 70 years. And when we isolate those periods that Brian spoke about, where the bond market went through convulsions, interest rates were rising, and presidents, no matter what side of the political aisle, had to act. In this case, Reagan was the first. Carin's already mentioned it. Tax reform focused on things like entitlements. Social Security retirement age was lengthened under Reagan, and really important to point out that this was a 40-year phasing in of those changes. We think that if we look at the precedent of the 1980s, the tax reform on entitlements will most likely be laid at the feet of younger generations. It will not heavily or materially impact existing retirees, existing recipients. I could say from my mouth to God's ears, but we have this precedent from the 1980s. Likewise, Reagan raised Social Security payroll taxes. Same thing with Bush in 1990. You can see that, as Brian was referring to with the Read My Lips. Fun fact, Brian, my favorite columnist in the Wall Street Journal, Peggy Noonan, she was formerly a speechwriter. She is credited with that phrase. She wrote that speech, apparently. Anyhow, just a little sidebar. These are remember those 1980, 1990 timeframes where we had deficits in excess of 5% or nearing 5% of GDP. We are at 6% today, and I say that Biden's feet are not held to the fire because the bond markets, although rates have risen, they haven't gone through the convulsions that we had under Reagan's presidency. And it was the same for Biden's predecessors with Trump and Obama. So if we look at what happened under Reagan and Bush, though, with any rattling of nerves from the bond market, then we would assume tax reform will move swiftly by our legislators and White House. The comments that Carin made about the variety, there are a multitude of options that we can pursue. As the wealthiest country in the world, $100 trillion of household net worth accumulated in just 15 years, by far the wealthiest GDP of any country, we have a variety of options we can pursue to solve this problem. Especially if we act sooner rather than later. I just wanted to bring one example to the fore, which is a VAT tax. That's a value-added tax or a consumption tax. Of course, for all of you that have traveled in Europe, you've paid a VAT tax. You're quite familiar with this. As a financial planner who advises clients to save and invest, consumption taxes are not anathema to me because it allows you to it incentivizes savings. And it's something that the Congressional Budget Office has rolled out, is if the United States were to implement a VAT tax of, say, 5% at the national level, then you would generate over $3 trillion in tax revenue to fight the deficit over the next decade. The Organization of Economic Cooperation and Development, the OECD, that's a 38-country grouping that are countries all dedicated to democracy and free markets, and so they serve as an excellent yardstick or comparison grouping for economists. And of the OECD countries, we are the only country that doesn't have a VAT tax. I found that interesting. But there would be significant logistical hurdles and challenges because we have a state sales tax system, we have a federalist system in this country. It would be very difficult to unify sales taxes across all of the different state systems and incorporate a VAT tax. I'm just laying it out as an example where there could be a consumption tax of a modest percentage to give you quite bang for the buck in reduction of the deficit over time. Then we get to what I want to hammer home today, which are that income taxes are quite likely to go up over the next decade in an effort to fight the deficit. And usually this is where I would expect to get booed or heckled, but anyway.
We didn't put tomatoes on the tables.
Yeah, so, what I'm showing you here, the chart on the left and the chart on the right, these are effective tax rates. Chart on the left is the last 70 years. Chart on the right is the last 20 years. Our marginal tax bracket or marginal tax rate only tells us a little bit about what we pay in taxes because that's just the highest tax rate that we pay taxes on. Of course, we have a progressive system, so we pay taxes all the way up to that marginal tax rate. All of us, we have a good deal of deductions and tax exemptions, and some of us may get tax credits in ways that we lower our total tax liability at the end of the day. And so when we look at our total taxes paid divided by our taxable income, that's how we get to the effective tax rate. That's a far more authentic depiction of what we're actually paying in taxes. So it gives us a good foundation to compare and contrast. And when we look at effective tax rates in the last 70 years, for the high earners, they have come down. When we look at effective tax rates over the last 20 years, the century, for all income earners, all levels of income strata, effective tax rates have come down. Subsequent to the passage of the Affordable Care Act in 2014, the high earners have seen a ticking up in their effective tax rate, but those tax rates for the highest earners are still lower than they were 50, 60 years ago. And remember, there has been tremendous wealth accumulation over this century to date. Okay, this last piece I like to title Bring Your Kid to Work Day. As Carin mentioned, we had fun at playing the act of Congress in saying if we were to try and balance the budget, I shouldn't say that, if we were to try and rein in the deficit over the next few decades. Importantly, remember that dollar bill, we put the muscles on that dollar bill. We have exceptionalism of wealth, and we have such tremendous faith in our institutions and our bond markets from international investors and domestic investors. We have a position of strength in this country where we don't have to balance the budget in order to placate the bond markets and avoid a coming crisis. We only have to rein in the deficit to bring the deficit down to a percentage of GDP that is less than the economic growth rate. And I was just showing you, we've had tremendous economic growth. If we have economic growth that just hits the average over the last several decades of, say, 4 to 5%, and we have a deficit that instead of where it is today at 6% is brought down to 3%, that should do well to calm the bond markets and avoid the more pernicious side of a crisis. So this is just an attempt to rein in the deficit, and Carin spoke about the spending cuts. Those are all listed there in green. I have tax increases included here, things like raising ordinary income tax rates, but doing it at all income tax brackets, not just focused on the highest earners. The payroll tax increases of 1% respectively on Social Security and Medicare. As it relates to Social Security, that 1% increase, first of all, it's split 0.5 to the employee, 0.5 to the employer. That 1% is less than the increase enacted under Reagan's presidency. And then finally, corporate tax rate increase from 21% to 24%. 24% would put us right on the average of the OECD. This would reduce that primary deficit that Brian was talking about. So of course, the elephant in the room, the $1 trillion of interest expense that's just a known quantity that we've got to tackle and wrestle with every year from here on, and our children and our children's children, that is not on this page. We're just showing you $550 billion of savings in the target year here of 2030. We just took a year under our projections. And by 2030, if we save $500 billion roughly of the primary deficit, then the total deficit, including interest expense, would be roughly $1.1 trillion. And we've reduced the threat of crisis in the bond market. So I've said all of this, and like Brian said, nobody's thrown anything at me yet. I'm going to get along while the getting's good and move it back to Brian.
Thanks. Let me have the clicker.
Oh, yep.
Okay. To wrap things up, because we live in an era of social media, TikTok, Instagram, or as I like to tell my kids, I neither Snapbook nor face chat. So I want everybody in this room to understand something very clearly, because in this social media world, people confuse advocacy with analysis. We're not advocating a change in the sense that we think that everything that we've outlined in the Wagner-Sullivan deficit reduction proposal are the end-all and be-all. What we are analyzing is that we are here. There is no more long-term future absent some action, number one. Number two, we believe that Congress and the President will take no action of their own accord. Number three, as has occurred in the past, the bond market will be the source of the action. It will be the motivator of the change. It can either happen because the bond market places steadily increased pressure on the government, as occurred under Reagan in the 80s, as occurred under George H.W. Bush in the early 90s, as occurred throughout most of the 90s when Clinton was the president and the Congress was controlled by the Republicans. When the bond market removed that pressure in the early 2000s, when interest rates began to fall, the government, under a Republican president and a Democratic Congress, and then under a Republican Congress and a Republican president, and then again under a Democratic president and a Democratic Congress, and then again a Democratic president and a Republican Congress. The policy did not change because of the change in the political makeup of Democrats versus Republicans. It changed when the bond market made it too expensive for the government to continue on the path that it had previously been on. Then, it's important to also remember that the government is not a household or a human being. And in fact, the government does not need to pay back its debt. That's what Mike just emphasized. Because the government lives in perpetuity. The government, there, however, needs to refinance its debt constantly and continuously. If the government starts to have trouble refinancing its debt, it cannot pay its bills tomorrow. That's why the bond market is the one that motivates action. The government is like Lehman Brothers. If the bond market does not refinance the debt, it's not debt that is coming due in 10 years, 20 years, 30 years. The overwhelming majority of the government's debt comes due tomorrow, next week, next month, 12 months from now. That's why the politicians ultimately are highly sensitive to a bond market that motivates action. That has happened before, it is not happening now. We anticipate, our analysis is, it is going to happen. It's going to happen not just in our lifetimes, but in the very near future. And we are your wealth managers, we are your financial planners. We are getting ready for the inevitability of higher taxes, lower benefits for the rest of our lives, the rest of our children's lives. We're planning, that's our analysis, to avoid that stark reality, I think, is irresponsible. But Mike said something very important just a second ago. We do not need to eliminate the deficit. What we need to do is get the deficit as a percentage of the economy to be a little bit less than the growth rate of the economy. If you look at the chart, the gold line is the growth rate in the economy each year from 1970 until the financial crisis. And you will notice that in every single year, the gold line is bigger than the blue line. And there was even a few years where there was a surplus, where the blue lines were negative. Since the financial crisis, there's almost never been a year, or I should say the overwhelming majority of years, the blue line exceeded the gold line. It's as simple as that. The blue line of the deficit as a percentage of GDP must fall below the gold line. That is the only sustainable path. The bond market understands this, and at some point it will react. If we look at the blue and gold lines on this page, the current Congressional Budget Office estimate is the blue line. What the Congressional Budget Office does is it takes current law and bakes it into their forecast of the debt and the deficit. One thing you really must know is that the tax cuts, the cuts to marginal tax rates that occurred in the 2017 tax law, if you remember that law. Trump was president at the time. We had a 2017 tax law that cut marginal tax rates. Guess what? Those sunset at the end of 2025, meaning former tax rates snap back. Every piece of data that we have shown you assumes those tax rates go back up. So all of the tax increases that we are now discussing and have over the last hour are on top of those former tax rates coming back. The Wagner-Sullivan proposal gets all it does is reduce, never mind the details, all they were trying to do was get the deficit as a percentage of GDP to about 3%, because guess what? Economic growth is about 4%, including inflation and everything. If the Congress were to enact their proposal today, you will notice that in the coming generation, debt would only fall to about 90% of GDP. The Congress is not going to act today. But at whatever point it acts, if all it does is reduce the deficit to something slightly below the growth rate, that is the point at which we will see a stabilization in our debt situation. So the longer we wait, of course, the more it needs to occur in order just to keep the situation stable, which is why the bond market will eventually react. It reacted in the early 80s, it reacted in the mid 80s, it reacted in the early 1990s. All of these points in time were when the government passed tax increases. With that very optimistic assessment, but I hope realistic, we're getting everybody ready, and I know that in your heart of hearts you knew it before you walked into the room, that the next 20 or 30 years we will be planning for you a world of higher taxes, somewhat lower benefits. But what will not occur is a radical shake. If you listen to the extreme rhetoric on either side of the political spectrum, the end of America, the collapse of the dollar, what have you, no. We are a rich country. The size of our government, federal, state, and local, added up combined as a percentage of our economy, is the smallest in the entire developed world. In fact, if you really want to get nervous, live in France. Their government's 20 percentage points higher in terms of their economy. We will not even become like France from that perspective. So I will now turn it over to you and open up for some Q&A, and we're happy to answer anything of a more optimistic nature as well.
Brian, thank you, and all of you. This is really quite interesting. I have a quick question. One thing that seems to have changed from the past is the Federal Reserve now buys a lot of treasuries, quantitative tightening, or easing as they call it. Now, right now, they're not doing that. They're actually selling. But will if the bond market reacts, what is to prevent the Fed from just stepping in and buying the bonds? And if that happens, what is the consequence?
Excellent question. We start out right away with full punch. Maybe I'll throw in my 2 cents and then inflation. That's what's going to, if you want to wonder why, what would stop the Fed from stepping back in? Inflation. That's why we have inflation. We monetize the debt. Mike talks about this quite a bit, so I'll turn it over to him for maybe a little bit deeper dive.
Yeah, we just had a bit of an example of that. One of the earlier charts Brian was showing that over the last couple of years, debt to GDP actually went down a little bit because there was monetization of the debt inadvertently. But the inflationary gut punch that we all suffered from is the byproduct of monetization and something that I think we would all want to avoid. It's certainly something in my career that I've wrestled with ever since, starting with this firm a few months before the financial crisis and the Fed's great experiment of buying up so many Treasury bonds and, the size of the Fed balance sheet almost reaching $9 trillion by the end of the COVID 2020 year. I've been placated watching those numbers come down recently. I think Chairman Powell and other members of the Fed committee have made it clear they don't want a massive balance sheet. There's too much meddling in the economy if they get much larger. I like to think of it in terms of, roughly a $7 trillion Fed balance sheet, and we have over $100 trillion of bond and stock market capitalization overall. So relative to the size of the markets, it's not so bad, but it is disconcerting. All of what we just spoke about also, we know there will always be recessions. Hopefully there will not be another virus experience like we just lived through, or terrible wars. But we recognize that there will be bumps in the road where the Fed will have to come in and be dovish and cut interest rates and potentially add to the balance sheet again. But I am definitely happy that over the last year, they have been reducing the size, and that relative to the broader economy, it's actually not grotesque. So,
No comments. Christian?
First, great presentation. Could you speak to how GDP is going to be affected by the debt loads overseas? Because you alluded to it in some of the slides, and how that affects your projections.
So maybe if you could expand on, so overseas debt, meaning anemic economies overseas, not helping
In much the same way you talked about government debt for us. My understanding is a lot of our trading partners have huge debt loads, way worse than ours on a percentage of GDP basis?
Yeah, I think that we would see a slower growth environment. I think that to Brian's point, if we look at like the last 40 or 50 years, total growth in this country has averaged over 5%. And so we were being conservative and hedging down a little bit on the growth rates we were assuming in our models to just 4% because we feel like we're in a slower growth environment overall. Demographics overseas, if we're using like Germany or Japan as examples, are even worse than ours. Our demographics are actually pretty strong relative to the other homes on the block. I think that we would assume lower growth overall as countries, our trading partners, grapple with their own high debt loads. There are a number of countries, however, that have lower debt to GDP ratios than us. And I think the big offenders are Italy and Japan that are higher than us. Germany has such attractive ratios of debt to GDP, but then they have anemic growth on the other hand.
Can you hear me? One thing I would expand on Mike's comment, and this is focused on Japan and Italy, to a certain extent, Germany. There's a chicken and egg problem. That how did Japan in particular become the most indebted country in the world? Well, actually, what's interesting is, first of all, they've had 35 years of deflation. So not inflation, deflation. Prices have fallen in Japan ever since 1989. Combined with that deflation, they've had now a decline in their population, and their ratio of older to younger people is significantly higher than the United States. So when we look at that scenario and we say, oh, by the way, we're giving you this warning that the United States is facing some fiscal problems, we also have some serious assets in our favor. Our population, yes, it's aging. That's why we're experiencing a lot of the things that Carin talked about with the growth in the Medicare expenditures and Social Security. On the other hand, we're aging much more slowly than almost any other developed country in the world. Part of that has to do with a higher birth rate. Part of that has to do with immigration. So that's obviously a big debate. But immigrants have tended to lower our age and improve our demographics over the long run. But finally, we also don't have the basic problems and rigidities that are baked into the Japanese economy, the Italian economy, many of the domestic European economies. Christian can tell me right now, because I forgot, we did a search of technology companies on the planet Earth. What percentage are American?
Well, I just remember, I think we started with around, I think there's 80,000 publicly listed global securities, and we got it down to, this is technology companies, not listed in Europe or not located in Europe, and I think we got to 16 from 80,000.
Not located in America.
Not located, in America.
There are 16 outside the United States. Our economy is so dynamic, and there are so many things going well that I suspect will continue, that we will be able to handle this problem, but we're not going to like it. And it's going to be broad-based in terms of tax increases and spending cuts, albeit skewed towards the wealthy. And I am sorry to inform everybody in this room, you're the wealthy.
So I have a question. You have predicated your assumption on Congress and the president acting based upon historical perspectives. And I would venture to say that we are in uncharted territory with respect to political positioning on the part of both the president and Congress. And do you still believe that the bond market is going to be able to prevail and result in the requisite action, even given the situation that we're in?
Tough question, so we'll turn it over to Mike and Christian.
Well, I'll answer that. I mean, I think it is a very tough question, especially given the political environment. But even if you look at raising the debt ceiling, it might go into the 12th, 13th hour. But I really believe, and I think all of us believe, that capitalism prevails and that even our politicians don't want to see the demise of the U.S. bond market, the U.S. government. So eventually, I think they will figure it out. It may not happen before there's a bigger problem, but I think it'll get figured out.
Yeah, I mean, sorry, I can't figure this mic up. I do agree with Carin, and I think we kind of, as we laid out, as even just going back to October of last year, we saw the 10-year Treasury hit over 5%. You still never really heard anything in any news sources talking about the budget deficit. So I think it's hard for us to sit here and tell you maybe if the 10-year gets to 7, then you'll see action by Congress. But based on historical precedent, I do think that there will be action when you start to get a premium or a default risk premium if the 10-year would get to, say, 7.5%.
The one last thing I would say is I was talking to a client, I don't know if you're here today, so I apologize, who was telling me that depending on which way the election goes, they might move to Portugal. So I got a little curious about the political situation in Portugal. So I was looking up what goes on in the Portuguese government, and holy mama, corruption, talk about deficit problems, and demagoguery like you can't believe. And I was thinking to myself, the key to being happy, apparently, in a political environment is to not speak the language. So I think we always feel things are terrible and that it's the worst. And I will grant you, if our politicians took an IQ test now versus in the Reagan era, I'm not sure their scores would be higher. But I do believe that James Carville, when he said in the early days of Clinton's presidency that when he is reincarnated, he wants to come back as the bond market because they are the dictator of the world. And I think that still holds.
Sorry, back here.
Thank you. Most savvy investors are predominantly in equities and a small amount in fixed income. If we get back to a 1980s and knowing the government's slow to act and we can get 10 or 12% on a 10-year treasury, would you recommend for this room that we liquidate a lot of our stocks and just load up on 12% 10-year treasuries?
Can I answer? Yeah. Yes, probably.
The only time we wouldn't recommend it would be as if we have very high inflation. So if you're getting 10% on 5-year treasuries, inflation's running 20, we might have a different conversation.
Yeah, I look at it like it's an answer to the last 3 questions, which is, the political circus of the moment obfuscates the fact that we've had tremendous wealth in this country, unrivaled by any country in the world. I started with this firm the same month that Bear Stearns had to arrange an overnight deal with JP Morgan because they were going belly up, and it was really the canary in the coal mine to the financial crisis. And there were very few courageous people who wanted to stay in equities and then still sleep at night. And it's like Brian was just saying, or Carin, the fact that we've had $100 trillion of household wealth creation since that time is just phenomenal. And yet it was an incredibly sobering time, just as the current political environment is sucking up all the oxygen, and it's incredibly sobering. But to think about, I have the advantage of having that lens of starting with this firm right into the abyss, and then sitting here today, and the market's hitting all-time highs once again, and I know your portfolios. I know how well things have gone, and so yes, if we could have some sense of security that the bonds will be paid for, which I believe we would, then we would be shifting more to fixed income in that environment. We already are shifting a good majority of our retired clients in this room into bonds, U.S. Treasury bonds, over the last few years because those interest rates are far more attractive these days.
the very wise and attractive client that just asked the question, I hope I'm not throwing you under the bus by saying he once told me that he wants to propose a constitutional amendment that anybody that claims they will move to Canada because of the political situation in America 3 times must be required to move to Canada. There's something in that.
Are
we doing on time? Oh, good. Maybe
Not
one
not
more.
one question on artificial intelligence or something like that?
Hi. You didn't mention the fairly obvious thing with Social Security in the GHP solution of just lifting the wage cap. And maybe that's not a very attractive thing for anybody, or maybe it's not a very big revenue producer, but I think it is.
It's funny that you would mention that because Mike, in the Wagner Sullivan proposal, Mike and I had a lot of debates back and forth about that one. Mike decided he didn't want to pay that for this proposal, so we
to
didn't
save
include
Karen's
it,
after-tax income. I was trying to save her.
yeah, the answer is I personally, I think most of us believe that would be low-hanging fruit. It's a tax on the rich, and just to the point of current workers paying for current retirees' benefits. It really makes it a little bit more one-for-one. So I think that is likely something we will see in the future.
Just to inform the room, the current payroll tax is capped at $168,000 for Social Security. There's no cap on Medicare tax, but the Medicare tax is only 1.45%. But I have to pay roughly 7% Social Security tax up to $168,000. So if somebody's making wage income of, say, $800,000, only a quarter of that income, or less than a quarter of that income, is taxed at Social Security. So if you remove that cap, that actually would create, we had these charts because we only tossed that out in the 11th hour. It creates a pretty significant boost to revenues.
By the way, one last thing. Because I mentioned we live in this world of YouTube and social media, and we are recording this presentation. So we made the decision to only use data points that were quantified by the Congressional Budget Office. As you might suspect, the biggest, the most impactful things that could be done were not quantified by the Congressional Budget Office, which includes raising the Social Security tax on income, which includes putting premiums on Part A for Medicare, deductibles. All of those things were not quantified, but in fact would be much, much larger. All right. We've scared everybody, I guess. Thank you.
Enjoy the museum.